2017 and looking back to when you got your license in 2020, whether events have changed the way you think about these things. But that gives you an opening really to talk about why you think this market's going to grow, what will make it grow, etc.
Great.
And with that, we need to start, I think, Wendy.
Yeah, we do. Hold on. I'm just doing the thingy. Right, we're now on YouTube. That's all fine. Okay, right. 5, 4, 3, 2. Go, Dominic, go.
Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance, and welcome to our webinar, Is Tokenization of Privately Managed Assets a Dynamo, a Diversion, or a Dead End? As the notion of tokenizing the vast $120 trillion global bond market, or the only slightly smaller $105 trillion global equity market, or indeed the $64 trillion global mutual fund market, has come to be seen as unrealistic or perhaps even unnecessary, tokenization enthusiasts in particular have alighted upon privately managed assets as a sector that could benefit from the enhancements that tokenization promises. In other words, value now for owners of future cash flows, liquidity for physical assets, as well as financial liabilities, lower transaction costs, lower servicing costs, a lower cost of capital through access to a broader class of investors, and even entirely new forms, perhaps, of corporate ownership, such as DAOs. On this view, tokenization of privately managed assets will become the dynamo that powers the acceleration and growth of the digital asset industry, precisely because privately managed assets have yet to benefit from the advantages issuers and investors enjoy already in the public securities markets. One optimistic forecast has it that privately managed assets in digital form will add up to a $16 trillion market cap by the end of this decade. That's nearly twice the size of active, I emphasize active, privately managed asset markets today as measured by McKinsey in their annual survey. But is the current focus on privately managed assets just a diversion from the failure of mainstream debt and equity tokenization to take off, a refuge from the faltering initiatives to tokenize conventional mutual funds, or indeed a retreat from the patchy progress of the previous favorite, real estate? In other words, are privately managed assets a faute de mieux strategy, one made for want of a better alternative? Or are they, even worse, a diversion from the harder work of building an entirely new operating model to support the creation of genuinely native asset markets, which, far from waiting for the traditional markets to catch up, owe nothing to the status quo? If there are any of these things, and there might be none of these things, there might be something completely different, privately managed assets might well turn into yet another blockchain-led dead end. And certainly recent events, from the collapse of Terra Luna through the failure of FTX to the decision by the ASX to rethink its blockchain-based CSD, have given skeptics plenty of ammunition to work with. To help us debate the case for optimism and the case for pessimism and the many points which lie between those twin extremes, we're joined by 4 industry leaders whose businesses address directly the challenges set by digitization of privately managed assets. Patrick O'Meara is chairman and CEO of Invenium Capital Partners, which identifies, captures, and processes the data investors and their service providers need to value privately managed assets accurately. Kevin Montserrat is co-founder of Consilience Group, which provides an infrastructure that enables privately managed companies to digitize their assets in order to access the capital and professional expertise they need to grow. Oyi Chu is CEO of ADEX, the Singapore-based digital assets exchange that enables independent investors to invest in private equity and hedge funds, real estate, and other private market opportunities. Dave Hendricks is CEO at Vitalo, an SEC-registered digital transfer agent that connects and enables members of the digital asset and securities ecosystem. Founded in 2017, Vitalo aims to transform and tokenize illiquid private assets to make them tradable and transferable in a very similar way to public equities. In addition to our panelists, as always, we also have you, our audience, and all 5 of us encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of your Zoom screens. Indeed, we've had at least one question already. I won't be saving those questions up to the end, but we'll answer them as we go along, so you can be an integral part of this discussion right from the outset. But I'd like to begin with our panelists, and I'd like to begin with Oyi Cho in particular, by asking her whether we're right to be getting as excited or unexcited, depending on our temperament, about the opportunities in privately managed assets. At ADEX, you're committed. Unlike many tokenization exchanges, you're also doing plenty of real and regular business. And the survey with BCG I referred to a minute ago, you believe this could be a $16 trillion market as early as 2030, the end of this decade. So if you look back, Oyi, to the origins of ADEX as iStocks back in 2017, you've got your operating license from the Monetary Authority in 2020. Do you think the business that set out 5 or 6 years ago to be the next generation capital markets platform has ended up in a slightly different place to what invented the business thought it would be? I mean, in other words, have events forced you to change course somewhat, or are you exactly on track from where you started?
Yeah, thanks, Dominic. I don't think everybody sort of ends up where they started on track. But what was quite interesting when the business was created and thought about in 2017, it was really about private assets and how do we get that democratized, because we felt some level of financial uninclusion or that around private market assets, private equity, VC, whatever that might be. And that was not really in the hands of mass affluent, retail, or even high net worth, right? It was quite difficult to get there. And it was a confluence of that idea and the thinking behind blockchain and what distributed ledger could do to solve that, I think got us started in 2017. Now, when we got the license in 2020, that really started our path to really a strong relationship with our regulators in Singapore, MAS. And we were one of the first to help them think about what does securities and tokenization mean in that combined construct, right? And so we can talk a bit about how our regulators see that. And if you asked me if we would do this BCG study in 2017 or 2020, I would have thought, we might be insane to even think about proposing that this number even made sense. But last year when BCG spoke with us to do this study, and we sort of dug into the numbers, and over time, ADEX has also become obviously a big champion of tokenization and securities tokenization. Because we have operated for such a while, we've run so many transactions in so many structures and so many forms that we're very confident in saying that we know that blockchain will disrupt a lot of traditional financial securities. And of course, private markets is where that impact is immediately felt. So that particular study today, it's not that tokenization will create a new asset class, but tokenization will take over a very large part of that asset servicing and that execution of those private market trades. And so if you ask me sort of how that's evolved today, tokenization has become much more at the forefront of interrupting TradFi. TradFi's really had to stop and think about it. And in fact, we ourselves have built from a B2C solution to a B2B2C solution in reaction to a broader thinking ecosystem push around how do we then do this in an ecosystem form instead of small little platforms trying to succeed by themselves.
Thanks, Oyi. Kevin, you've heard what Oyi was saying there, and I think about some of that she still thinks this is a disruptive force, that it's going to build its way into asset classes which are presently serviced by traditional means. I talk to so many people who've found recent events a great excuse for actually doing nothing, and in effect, you can see why they do. But what would you say to people who say, well, it's all too difficult, I think I'll wait and see? And in effect, what are you doing to counter that attitude?
Well, I guess I will start with answering with a very philosophical answer, right? Do you believe in Darwin, or do you or in theory, or do you not, right? So I think nothing is the same. Everything is evolving, and I think if people keep doing the same thing that they were doing yesterday, they're going to have yesterday's results, right? So I think just from that philosophical point of view, there are two camps. There are people who are doing and then are testing, and they are not afraid to break things, and they are really learning, and that learning is probably the most valuable things they can do. And there are the others who find excuses, and we're going to find millions of excuses, and who are just not going to learn as much as the ones that do. And so from that very standpoint, I believe that learning is always the one that wins over time. Okay, so first of all, that's the very kind of the foundation of that. Second of all, tokenization is the tool. And then tools, you can use them the way you want, right? Some are using different tools, and so you basically, all of those organizations have the right to disregard or use those tools the way they want. And so I think it brings us to what we can do with the tools, right? That matter, right? And so if I just look at how the world of asset management is evolving right now, according to what Oi was saying, is that if it's true that there is $16 trillion of illiquid assets that are locked right now and are going to be unlocked, well, it's basically a new market that asset managers can tap into. And the truth is that we need to have the right tools to make those assets liquid, whether we're using tokenization, whether we're using blockchain, whether we're using smart contract or coconuts, we don't care. What we need is the right and the most robust tools to get there. And so far, if a few people like Larry Fink and KKR and others are talking about tokenizations of assets, it's because there is something. We may all be wrong and fool and look at this in 2-3 years and say we got it wrong, but the reality is that it seems like we are into something.
Dave, what's your perspective on this? Is there a hybrid solution here? How important is it to hook up the traditional markets to these new blockchain technology-driven financial instruments? Your business is operating, I guess, at the cusp between those two. And maybe give us a US perspective as well. We've had an Asian and European one.
As I was saying before we got on the call, it's and I think this is kind of apropos, what we heard from Kevin. There's an evolutionary approach to this. It's very difficult to make the leap from TradFi, which is often referred to as Web 2, to DeFi, which is often referred to as Web 3. So, we Vertalo, I think we find ourselves, we're registered we're an SEC registered transfer agent. We find ourselves at Web 2.5. And the reason is all the assets are in Web 2. Okay, all the technology, or at least the new technology, is in Web 3. And if you expect that,
just to be clear here, Dave, and people will be surprised that SEC registered transfer agent is still necessary in a fully blockchained environment. I think you're about to explain why that is the case. All the assets are still in Web 2, but do feel free to elaborate on that point. Why
thank you.
Why this role is necessary.
Thank you for setting me up like that. This is, as I think as Pat will say, following me, it's all about the data. Okay. And if you can format the data correctly, then you can act on it. And what this is really, what tokenization of real world assets or asset tokenization really is about standardizing and preparing and formatting the data so it can be made more transferable, more tradable, more reliable. And if you've got all kinds of if you've got stuff which is different within a group of companies, just different, people don't know how to deal with it. So Vertalo transforms data which is stored on central databases or in spreadsheets, and turns it into tradable and transferable digital asset securities. By transforming and standardizing data, you can actually create markets. The reason why private assets are not tradable and transferable the way that public equities are is fundamentally a function of the lack of standardization of the underlying data. Standardization of the value data in case of Pat, and lack of standardization, so it's ready to be put onto a platform like an ADDX. Okay, if you don't have those standards, then you can't you can't trade effectively because you've got a rail gauge issue. So I think that the transfer agent plays an especially important role because it moves database, it manages the books and records. This is not going to be done in wallets in the near term in people's self-sovereign wallets. It needs to be done in a semi-custodial environment that's trustful and frankly, so that everyone can parse it, everyone can connect to it. And so that's what we're in the business of doing, is managing data. I wouldn't say it's an intermediary. I would say it's a tube, okay, that moves it from one place to another. And I think it's very, very important to, like, if you don't focus on the data, you're missing the whole point of this.
Now, Pat, I suspect that Dave has just highlighted something there which is extremely profound. We've spent a lot of time actually looking at this through a technological perspective. Kevin mentioned actually the technology is a second order matter. What matters is the opportunity opening up this asset. We each pointed out it could be a very large asset class to asset managers, and the technology you use to get there isn't as important as actually having price, valuation, revenue information. And I don't want to bowl you a sort of underarm bull here. I don't know whether you have that concept in baseball. We certainly have it in cricket. But data is your business. So what sort of data are we talking about here, which can be put into the hands of investors and indeed exchanges and participants in exchanges to help these privately managed asset markets grow? What do they need, and where do you get it from?
Yeah, sure. When you have immediate access to real-time data, you can, people with capital are going to arb that data. And in doing so, they create liquidity. And high frequency trading, activities like that in the public markets drive liquidity in many underlying stocks. And that's made possible by a lack of latency in data. But when there is latency in the data, when you're looking at an infrastructure asset, when a port, a refinery, when you're looking at a real estate asset, when you're looking at private equity, when you're looking at private credit, the latency in the data creates a high transaction cost, right? Because you have to diligence the data, you're not sure that it's good, and with that illiquidity because of the latency on your data, there's the liquidity isn't there, the ticket sizes are much greater because the diligence costs are much greater. And so what we're doing is using new technology to do away with the need for a centralized database. So if I'm going to look at the information, it all needs to be in one place, but rather how do we pull and surveil asset performance all the way at the edge, at the refinery, at the building itself? How can we view that data? How can we audit that data? How can we have on-demand transparency, auditability to the source data, and then deliver that real time to a computational tool without a middleware of Gates 1.0, right? Excel spreadsheet and a junior accountant doing 10-finger automation, which is how the alts world works right now. So what we're doing is instrumenting the data so that we can streamline it into a computational function to know the state of the asset, so you can know the value of the asset, so you can value the capital stack, running it through a waterfall and a carry calculation all the way through. You value that capital stack, so you can trade that capital stack, which then allows you to value a fund, right? Like an interval fund, a closed-end fund, et cetera. And so what we're doing is getting that data and pushing it through computational tools, right? With instantaneous delivery from a decentralized environment, doing away with the centralized database. But this happens where we connect, and if you think about us from the back office to the middle office, Oyi is the front office to the middle office, right? She's literally creating new front office opportunities, and where you're using a ledger that is not a books and records ledger that is maintained by an administrator, but you have a distributed ledger. And because of that, the instantaneous agreement on the state of the ledger allows those microservices to happen really, really fast, right? And if you think about the movement of the internet, you had a bookseller and then they were picking and packing. You'd put that in, they could see more people come in to their shop. That's great because they could come in digitally, but they were picking and packing. But it wasn't until you integrated logistics and you integrated supply chain and accounting and you had massive distribution shops that Amazon revolutionized what's happening. When you can have back office, middle office, and front office looking at the same data in a fully decentralized environment where you don't need the world's largest database in the center and you're doing away with that latency, what you're going to see is instantaneous agreement on the state of an asset and the state of ownership. And if you can do that, you're going to see people with massive liquidity coming in and arbing that when they see the true value and the true state of those assets. And with that, that opens the door for smaller investors to get in because there is liquidity in the underlying assets. And so Invenium is powering kind of back office to middle office and then plugging it into all these front office solutions. Dave, as a transfer agent, is a middle function that has a market function that if the transfer, somebody who lives within an exemption, blows up, right? The SEC needs to know who am I going after. So he is, while the middle function is more efficient, the function is the regulatory function has been fulfilled. And that's not going to be fulfilled by a smart contract for 30 years, maybe 20, but not for a long time, if ever. But in the regulatory environment we're in, you need these middle functions happening more efficiently that allow OIE to have new novel forms of front office distribution, delivery, new audiences, new mechanisms to access the market. So anyway, but it really is connecting all these microservices that have agreement on a state of a ledger.
Thanks, Pat. Oyi, perhaps you could pick that up, and I'd like you to pick it up in a particular context. We've had a possibly very seminal question or observation by Willy Brammertz, who says tokenization alone is not sufficient to make private assets a success. What is needed is an algorithmic standard that represents the legal intention of the financial assets. Currently, there's still bundles of paper or spreadsheets, as Pat was saying a few minutes ago. I happen to know that Willy is kind of very interested in the Actus standard for financial contracts, where you reduce any financial instrument to its essential components so you can digitize it and exchange information about it more conveniently, with greater ease and across different systems. So and you as an exchange are in quite a good position to adopt standards of that kind to, if you like, turbocharge this data exchange process, which both Dave and Pat have been talking about as the key to unlocking privately managed assets. Do you think like that? Do you think about standards? Are you even aware of the Actus standard, or you?
No, but we if you look at private markets and why it's actually traditionally been so difficult to sort of move that from a certain type of investor, which is the large institutional investor, to the average Joe Schmo, right? It really is because there is no standard. I mean, stocks is, relatively straightforward, right? It's a company, you have disclosures and it's quarterly and, it trades, there's nothing too complex about that. Even cryptocurrency isn't particularly complex, right? But if you think about the different alternatives out there, the different sub-asset classes, the different structures that exist, they are actually across different geographies, different, tenors of the fund, different types of risk profiles. It's all over the place, right? Standardization is not going to happen, not so soon. But we obviously want that to happen because that's the only way that it can move towards.
But Oyi, could you not ask,
democratization, right?
Could you not get your issuers to adopt a standard in the way that they present the assets they're listing on ADDX?
So a lot of our issuers are still very comfortable with institutional structures. They kind of want the retail distribution without changing the product and the standardization for retailization. And this will take quite a long, we deal with many GPs. that harmonization is not happening yet. Certainly,
Dave, when
the
you're
thinking
done,
about harmonization is not happening yet.
yeah,
Right.
Dave, when Dave's done, I'd like to weigh in on this as well, for sure.
Okay, we
Yeah, I'm not sure whether I agree or I disagree with you, Uchi, because I'm not sure I understand your what you're saying. So let me be clear here. If you, in our case, like thinking Web 2.5, these are the things that you need to know: who owns something, what is called, what exemption or what, you know, what kind of structure is it under, what price was paid, when they bought it, what the restrictions are, where it can be traded. There's this long a data string that you need to have for everything. And there's nothing, tokenization does not change these basic kind of core elements of an asset, which is, you know, what it is, who owns it, what they paid for it, when they bought it, all those things. Those things are the same. Okay. The stuff that, you know, that Pat's doing is normalizing a lot of really different kind of data. So at the end of the day, you can look at it apples to apples, which is very, very important to do. And we need to stay apples to apples in terms of digitized versus, you know, non-digitized data, or else I don't even know what we're talking about. And so I think that we probably agree on this. There's upstream stuff, and I'm going to let Pat go off of my tee up for that.
And Dominic, this, when you think about Actus, I think they're right on the money, but they're assuming that the outcome will be causal, right? Which is not true. And so one of the things that I love is the London Stock Exchange. When I first started meeting them in early 2017, late 2016, they said, you know, we've been dematerializing assets forever. And in our very first meeting, that they told me a story that the primary driver of the architecture of a ship going to the British East Indies was not how seaworthy it was, but so that the hold could be divided into 12ths so it could be funded quickly and easily, right? And the market drove, once the market was there, a standard for how ships were being built so you could trade the returning ship's whole, right? And so the market drove the standardization. When you try and preset the standard ahead of the market being mature, what you're going to do is you're going to drive the people around and away from the standard, right? And so today we have a data dictionary. Every alternative asset manager in the world, you know, connects their definition to the Rick's Red Book or to the MSCI definition or whatever it is, and then they note the difference. And the reason is they all slice and dice their tool because they're not homogeneous assets. No refinery is created the same. Every commercial real estate asset is a little bit different. Every private equity one is a little bit different. And they all want to slice and dice their accounting so that they're first or second in their class, right? So then what they do is they connect to that. And it's only as the market and funding forces homogenization of the structure. So ISDAs, right, for swaps, the market forced that structure so it would become more efficient. We're still a little ways away from critical mass for standards to be generated, but they will be standards that don't come out of academia. They will come out of the market players. I'm sorry, that was a long answer.
Yeah, Kevin.
But you know, and I exactly.
Sorry, you go first. Yeah. Well,
No, I was going to say I agree with Pat, right? I think you know, we've for example, we have open-ended funds, right? We have NAV that, you know, Pat and I debate about what should be NAV for private market assets. Is that consistent across the different players, right? Does Hamilton Lane calculate it the same way as Partners Group, calculate the same way as a closed-ended fund of KKR? So there is a lot of nuance in that data that isn't particularly, and if you don't standardize it, you don't create transparency around, or you don't create transparency, not even talk about standardization, then what are we talking about in terms of transferability, valuation, and trading? So, and then let alone, I mean, in the US, you probably have a few US structures, but when you start talking about Cayman, and Singapore VCCs and, Luxembourg structures, and the US have different selling restrictions. I think that's where it becomes a lot more complex than just saying, oh, we should standardize it, right?
It's exactly right. Yeah.
So
anyway,
Kevin,
so
can I ask what you think of what's been you've heard so far? Because I think if we'd had this conversation a year ago, we'd probably be sat here talking about the benefits of tokenizing privately managed assets, liquidity, fractionalization, democratization, lower transaction costs. Some of the things I mentioned at the outset, we'd have talked about the business case being there. You'd be far more efficient than what you're doing now. You'd be mad not to do it. Now, the conversation this afternoon has been about data and digitalization.
Exactly. I think
it's not been about
exactly. I think we went a bit off topic. I think absolutely. I think it's important. It's part of the private market infrastructure. But I think with private market infrastructure, it's about data, but it's not about data. It's about also how you actually create that trust, how you create this auditability, permanent auditability, and how do you create this market? And because arguably, right, a price is a function of the supply and the demand, right? You don't need gazillions of data to kind of know how much a house is, how much any art pieces, and so on, right? The markets are working already. I don't think we need to reinvent the wheel. There are probably going to be so much improvement down the line, of course, with a lot more data coming in the market, and the ones who manage to crush those data may have an edge on the market because they may understand the price better than some others. And this is basically what finance is. Finance is about basically knowing something that others don't. So if the market is so harmonized and is so decentralized, then there's not going to be many money to be made because everybody has access to the same information. And if everybody has access to the same information, then the price is corrected already. So there's no money to be made. Full stop. Now, when we talk about, when we started,
that's assuming the markets are efficient, right? Which is a bad assumption for most of world history.
Well, but so I think, when Dominic, when we started in 2017, we were looking at turning asset into money, right? We were dealing with many entrepreneurs and emerging managers having access to intellectual capital, pool of intellectual capital, right? How do they really monetize intellectual capital? How do you create companies? How do you launch a VC? How do you launch a private equity? You need to raise money, and you cannot monetize the intellectual capital part, which is where we started. So we started to look at tokenizing assets as a way of basically paying people to do work and to build companies. That's how we started in 2017. So we were creating 1 token per startup, and we rapidly realized that there was no data, there was too much risk, it was too illiquid. And so what we did is we transitioned towards basically the tokenizations of funds. So we launched our own fully tokenized fund. We operated it, we deployed a few million. And we had to stop and we say, we now know how it works. We can see the difference between running a traditional PE, a traditional VC, and a fully tokenized investment vehicle. And we can see how the economics would work. And so that's why we transitioned to a white label solution last year, because then we realized every asset manager can now walk into a client's office and say, I know you've got 60% of your assets that are illiquid. Okay, therefore, I cannot take a management fee on illiquid assets. And now an asset manager can basically, with their own brand, with their own platform, can walk into those clients and say, well, I will basically now make 60% of your illiquid assets liquid. I can manage them for you, and I can increase the performance of your portfolio because now I've got a lot more flexibility, right? And this is where the role of exchanges, right, are very, very important, because then at this point, it's about how then do you distribute those assets? How do you connect to all of those exchanges? And I think the line between the traditional exchanges, right, and then the tokenized exchanges is going to be blurry, because I believe that over time, if there's a big market in tokenization, I think the NASDAQ or the FTSE or whatever markets they are going to be adopt that technology. And so there's going to be a harmonized market down the line. And so I think this is really what we missed here, is that what is it that we can do that we couldn't do with the tokenization? And I think Oi talked about it, but I think we need to focus on this. The world right now is basically too exclusive. The world of private assets is it's too much exclusive. there's not enough people be able to participate. And so what we need to do is we need to create a forum, and we need to create platforms where more people can participate in the private equity market, because this is where there is money to be made, right? This is where the growth of our economy is. And so all of those things are as important as basically able to create jobs, create companies, solve problems, and so on and so on. They are not about trying to make the market more efficient, in my view, not the capital market anyway, because the capital market is already very efficient. It's about really taking the private market as it stands, making it much more efficient for building companies, create innovations, solve problems, creating things, and make money in that journey. But
so exchanges are going to do well in this environment. What happens to custodian banks and central securities depositories? And before you answer that question, I'm going to just share some facts with you. I was very interested to read in the International Securities Services Association survey of DLT in the real world. This is their 2022 survey. They're doing another one now, but this is last year, so it's a little bit out of date. But they put, it's a survey of 148 banks and CSDs around the world. So it's a pretty big sample of people that matter. And that survey found that they were spending a lot of money. Well, actually not that much money. I think it was 9 million by custodians and 5 million by CSDs on private debt, private equity initiatives. So these were actually just as important, if not more important to them than bonds or indeed the cryptocurrencies, which a year ago a lot of their clients were pushing them towards. We've seen the DTCC, the American CSD, start building this infrastructure for privately managed assets. So it's not like these entities are thinking to themselves, we have no role to play here. Dave, you've described the role that transfer agents fulfill here. I've been in many ways fascinated by this conversation, because it's not about disintermediation. It's not really about tokenization at all. It's actually about making these assets available through data, and a lot of the existing service providers just doing slightly different things, but all surviving and contributing to a more efficient solution.
Yeah, so I'm not sure if we're going to take issue with what Kevin just said, but this what we're doing here really is focused on private assets. Okay, it's not focused on public. Let's just make it clear for everybody who's on the call who's new to this topic. I am certainly not proposing that we bring tokenization of assets to the public markets. I think what Kevin said, if I understood him correctly, is that efficiency is not a problem. That is true in the public markets. The public markets have no efficiency problem. The public markets are over-optimized, if anything. And they're extremely efficient, so efficient that you can get front run on your retail trade in 100 milliseconds by a larger trading group. They see your order flow and they make moves based on your 100 lot trade, your 100 share trade. Okay, so that market the public market does not need to be fixed. The private market is where we're focused on here. Okay, now, in the private markets, there have been no transfer agents. Let's be really clear. There's no requirement for a transfer agent in a private market transaction. That's because until now, there was no transparency in private markets. They were not private markets. Actually, there wasn't a market. Okay, and transfer agents help maintain an orderly market. The order, it comes from who owns what. Mm-hmm. That's the most important piece of data at any company, is who owns the company. It's the oldest piece of data in a company. It's the longest lived database in any company, is its capitalization. What this technology does is not alien. Again, it uses distributed ledger to manage this ownership data, to transform it, to make it tradable. So for you TradFi people out there, we are not proposing on blowing up a whole bunch of structures. What we're doing is we're wringing like friction out of the whole system. Okay,
exactly. We're bringing more assets to play with, basically. Yes,
this is sadly enough, it's actually a super boring play. Mm-hmm. If you think about it. So don't get scared. Mm-hmm. It's actually making it so that the data is standardized so that things can be traded and transferred more easily. That's it. It goes, there's upstream stuff like what Pat's doing. There's downstream stuff to me at what Oichu is doing at ADEX. And the whole thing is moving the data through this set of pipes. Okay. And until you've got those pipes put in place, there will be continued systemic friction in private capital markets. Now, why should you be excited about this? Public markets are not going to do any IPOs for the next couple of years. Just deal with it. It's not going to happen. All the unicorns are going to get devalued. So they're going to figure out where they're at. The crypto markets are trading sideways, except for Bitcoin, which is the only true crypto asset. And there's nothing else for you all to do. Okay. So why don't you come over and start thinking about this market, which is way bigger than the public markets. Okay. Public markets are like a third of the private market. So you want to do something for the next couple of years, come and work with the folks who are on this call to make this market more efficient. That's the whole point of this. If there's nothing else.
I'd like to add something to what Dave, I think, Dave, you were very good on explaining kind of the big difference between the private and the public, and why there is a need for some form of decentralization. Because right now capital markets are very centralized, right, through those exchanges. And I think why Dominic, we don't think, like, I'm very much agreeing with Dave here. We don't think the role of transfer agents is needed here, because historically private markets work on peer-to-peer. You don't need to have a central party to sell your house.
But
you don't need to, yeah,
but you do.
But you do.
But you do. Okay. That's the version one thinking.
Exactly.
Kevin, was that wallets would replace transfer agents, and people, and like, if you've ever been a corporate secretary or CEO or
But
even
you do.
CEO,
Exactly.
you know that you can't do this.
Exactly.
You can't do it that way.
And then it's back to this. It's back to all of that discussion of basically bringing the existing world onto a technology, and that is basically data lakes. So that's technology like blockchain or decentralized ledger, to make this market more efficient, but where you have less central authority that can manipulate that price, because there's a criterion transparency and all of that pipe is in place. So yeah, I really like that point, Dave. I'm done.
Okay, we're into our last quarter now, and I'd like to talk a little bit about law and regulation. And a thought is prompted by what Dave was saying there about the importance of deciding who owns what. Now, in the UK, and I don't know whether this is mirrored in the US, I suspect it is, and in Europe, you know, who owns what in a crypto asset world has actually been quite a live discussion. One of the difficulties which businesses trying to get going in this space in the UK have faced is actually it's been difficult to describe certain types of token as property, and if they can't be described as property in law, they're very difficult to sell and buy and transfer between people. We're now starting to see court cases which arising out of various Bitcoin frauds in the UK, which have determined that these virtual assets are indeed property, which is kind of unblocking that problem. Now, we've had a question which is kind of relevant to this, and it's from a wealth manager who says, what I've seen so far, the majority of tokens are in real estate investments for direct retail investors. He asked, what are the legal and regulatory opinions and requirements to offer and promote these products here in the UK? I've seen various alternative investments in wine, whiskey, fractional ownership, real estate being promoted and advertised here in the UK, not as tokens, and they're not regulated. So what's the difference? Has the FCA given any rules or requirements for token promotions directly to consumers? In other words, if the token's offered here in the UK, but the investors are from somewhere else, do you have to be regulated? Now, my view about this is that yes, the tokens are, security tokens, which is what these the kind of assets we're talking about would be, are indeed regulated, as described by the FCA in its famous paper about the perimeter, what's regulated and what's not. So if you are owning these instruments in the UK, you're going to have to comply with all the rules that apply to a securities business. You're going to get licensed by the FCA. You're going to have to publish a prospectus. You're going to have to comply with the senior managers regime, and you're going to have to treat customers fairly, and so on. The wine and whiskey he refers to are outside that FCA remit. They're outside the regulatory perimeter because they're just physical assets, and therefore they're treated already as pieces of property, which can be bought and sold quite easily. And I've noticed a number of the real estate these sort of real estate investment clubs we've seen in the UK, for example, are not regulated either, unless they turn out to be securities or collective investment funds. That's a UCITS or an OIC or an AIF. As he points out, the fractional ownership, we've seen this in classic cars, for example, they're not regulated as security tokens because actually you don't have any ownership rights. Back to your point, Dave, nobody really owns this thing. Chance to drive it once a year maybe, or get photographed next to it twice a year, but you don't actually have the right to vote on it or indeed to receive any profits or dividends from it. So there's a rather long-winded way of introducing a member of the audience's question, but really asking, and Oyi, maybe you're a very good place. Singapore has built a reputation for being very advanced in its thinking about these things, while also being, it seems to be getting regulation right in a way that other jurisdictions are not. So describe to us the Singapore situation, bearing in mind our audience members' question about how certain is the law and regulation. If I issue, buy, trade a token, can I do that with real certainty in Singapore in a way I can't yet in London?
Yeah, in Singapore, the thinking is not that far away from FCA, right? A security is a security, even if you tokenize it. So from an MAS point of view, Monetary Authority of Singapore, the tokenization, they're tech agnostic in that respect. If you're handling a security, you're distributing it, you're trading it, it falls under the Securities and Futures Act. So, for example, our licenses, I suspect, like our colleagues here, are traditional securities licenses. Now, I think there needs to be a sort of, there's a lot of nuance, right? In Singapore, there obviously you can trade wines physically as well, but they're not regulated as well. But we, for example, have a partner who created a wine fund. That becomes a security, and that's traded on our exchange. So I think at the end of the day, and for example, you could actually securitize a classic car, right? The question is whether you want to be trading that as a security or you want to be trading that as an asset. Of course, as a security, then that becomes the added layer of regulation, right? We, as an exchange, do due diligence. We make sure that, the partners we work with, are proper provenance, governance, and valuation, right? Are the key tenets that I think we should be thinking about, whether it's a security or the underlying asset, but we just add the layer of protection because we're regulated. But as I said, I think there is and Singapore just sees that quite differently. There are some jurisdictions who initially came up with the idea of a virtual asset regime, and that caught cryptocurrencies and tokenized securities. And interestingly, you're seeing some of these regulators start to unpack that, because they're now saying, well, cryptocurrencies is cryptocurrencies, and that should be dealt with in a certain way. But tokenized securities are likely more and more aligned to the underlying securities laws. And if you see what BIS and the consultation and the guidelines for Basel for banks in thinking about balance sheet treatment of assets, they're now saying that crypto as defined as an underlying security that's traditional is going to be treated as a traditional security. So I think the world is starting to sort of move away from a single, what we call virtual asset capability, and shift in two ways, where cryptocurrencies will be dealt with in its own muddling way that's going to be dealt with. I don't know how that's going to play out, but tokenized securities will clearly be within each local jurisdiction of securities or funds, whatever that might be.
So the world is converging on a single model. Dave, you're about to say something.
Yeah, I mean, MAS and SEC are actually fairly similar in terms of its regulations. Here in the US, if you tokenize an asset which has been offered under a private placement memorandum, it's a dematerialized security. Okay, you can't store it on the blockchain natively because they don't permit that yet, because they don't see the blockchain as the source of truth. It's funny enough. I mean, these are still securities. Okay, they're tokenized, but you must represent them on a central database structure like Postgres. in order to satisfy the SEC's requirements. Anything which is offered to investors either under Reg A, which is crowdfunding, or Reg CF, which is crowdfunding, Reg D or Reg S, private asset, which is offered under one of these structures, is a security. Like end of story. Doesn't matter whether it was wine before that wine was fractionalized and sold, or trees or carbon credits. Doesn't really matter. It's really the legal agreement, which is what sets it as a security or not. Okay, as a difference between a security and, say, a loan. In what they did here in the United States, which is slightly different, I think, than MAS and FCA, was that they had a carve out for the trading platforms if you're going to trade tokenized securities. It's called the Special Purpose Broker Dealer. It was released as a 5-year safe harbor exemption. The last thing that Jay Clayton did as chairman of the SEC in December 23rd, 2020. Okay, and so these things are securities, plain and simple. They're not bearer assets. Anyone who's on this call, we're not talking about cryptocurrencies here. We're talking about dematerialized digital asset securities, and that's what we're all talking about. We may use different words, okay, but they're dematerialized digital asset securities, and tokenized or not, traded as a token or not. That's what they are. It's actually really, really simple. It just happens to be they're encoded differently.
Yeah, that's actually a very interesting point, Dave, because in Singapore, I think there will be eventually a move to draft dematerialization into whether it's Companies Act or the constitutional sort of part of it. And we say dematerialization, but we actually still do quite a lot of that legal work when we do that. So Singapore is definitely not 100% there yet.
And this issue was, of course, created by the technology itself, the difficulty of deciding where ownership resides, where a transaction is settled, and so on. And a lot of what we've been talking about this afternoon is actually the technology is a second order matter. What actually matters is bringing these assets into the public domain. So if we think about the role that regulators have played so far, from what Oyi is saying, it sounds like they've got it just about right, despite fielding quite a lot of criticism over the last 2 or 3 years. We've ended up with this model where cryptocurrencies are over there, they're unregulated. Everything else pretty much everything else is a security token. It's over here, it's within the regulatory perimeter. And I assume, and Pat, maybe you have a view on this, that issuers might not always like the idea of regulation because it increases costs, but they certainly like investors, and investors like regulation. So are we reaching the point now? If you look at what's happening, as Dave mentioned, with Reg A, Reg S in the US, this seems to be working as a way of getting privately managed assets into the market. Am I right to think that, Pat?
The trend is right. The narrative arc is right, but there are unfortunate data points that are contrary. And so as an example, I'll just give you, the SEC and FINRA in their famous 2019 joint statement on tokenized securities. I think security tokens are not really a thing. They're a little bit like unicorns. Tokenized securities are a real thing. And we could talk about the difference, but in that joint statement, they have a footnote that just says messaging services and how messaging, this is footnote 9, between a broker-dealer, a special purpose broker-dealer, ATS, and a custodian needs to consider, is it a clearing agent or a settlement function? Well, time out. Does that mean software which connects an ATS to a custodian is a settlement function and needs to be a regulated entity for its software to be utilized? And so literally we're getting former commissioner of the SEC, big legal opinions, et cetera, because when there's a lack of clarity, people don't implement. Do you know what I mean? And there's a lot of things that are undefined, right? And as things are getting defined, the mechanism by which, in early versions, we're having to literally build pop-up windows from the custodian to the maker or the taker of the trade that is a custodian initiated question in addition to the user interface, just so that it doesn't look like the ATS is asking the question. So unified communications aren't done, which makes ease of adoption harder because it's harder to utilize and it's harder to build, because each person's communication, because there's not clarity on what that functioning and what the messaging is, everybody has to speak separately. These are things that in 5 years will be sorted, but right now, literally, as we build that infrastructure for an exchange to have a multi-custodial environment and a multi-chain environment between the maker and the taker, so you don't have to have everybody with their assets at one custodian, which is, not reality. We're having to have more steps involved, which hurts user experience, right? But it will get more sophisticated over time. But the reason is the SEC, they haven't pondered what a messaging system really is in this environment. Do you know what I mean? And is that message that matches a pair, is that a settlement function, even if you have a CSD, a digital CSD, that's going to clear everything out? And that might be at the location of a custodian. So we're still
we've had this discussion though. We've had this discussion with them, Pat. So it's not published, but the thinking is evolving in that area. Okay. But I love the point you bring up. You bring up a really interesting point. It's a point of extreme nuance too.
The devil and the Holy Spirit are in the detail, right? Yeah. If you're gonna exist in a regulatory environment, you have to be able to say the way that we are clearing, we are settling, we are matching, the way that the maker and the taker are instructing. These things matter. The way that we stream data and set a NAV or a book value and the bid or the ask or above, and we trade on appointment, how that's delivered by geography, by regulatory jurisdiction matters. And as we sort these, we are seeing, I would say, almost every major institution we're talking to is now moving full speed into real world assets, digitizing their middle and back office so they can take advantage of what they know is coming, which is the new digital front office, right? And they're preparing to have automated data feeds in order to allow microservices to occur instead of having a single monolithic data architecture or systems architecture. And as you do that, you're going to see new players, you're going to see an ecosystem develop, you're going to see real DeFi develop. But it's the definitions need to be clarified on what things are. And they're happening slowly. But they're happening.
Okay, thanks, Pat. I'd like to, we're into our last couple of minutes here, and I'd just like to address a question which has been raised by Galen Simmons. It was an interesting one. The question is, for private issuers that traditionally rely on institutional distribution, what types of regulatory structures and adaptations are being explored to partially tokenize a fund? So I know you're a private equity or hedge fund, you run around trying to raise money from pension funds and family offices. Now you might want to tokenize part fund. Is this an issue you've come across? I know that you're listing hedge and private equity and real estate funds. Does this issue come up in your work?
We do that all the time.
Okay, right. That's what would come up. It's what you do all day.
Every single time, every day. I mean, as we spoke about, most GPs or most fund managers are very comfortable dealing with institutional. So there is going to be an adaptation. From a regulatory point of view, at the moment, it's not so much, well, obviously if regulatory changes the way we talk about dematerialization and fractionalization and access to mass affluent and retail, that's a big shift. But for now, it is more legal adaptation. It is about, we do what we call sort of a token wrap per se, that sort of makes sure that the tokens are aligned completely with what the underlying security is. So there is adaptation, and has been done many times, we sort of quite, and certainly doable.
So this is a really straightforward thing. You can do a 40 Act fund and you can tokenize it. Okay. End of
But
story.
but Dave, what if your 40 Act fund is already out there in traditional form?
So you can tokenize it. You can tokenize it afterwards. So just so everyone understands, when you do a tokenized offering or you have a tokenized asset, it doesn't need to be sold in a token form. Okay, we take 90% of the stuff that we do has already had money raised against it, one or more rounds, and then we can take that data and tokenize. We can tokenize it at any time. And so it doesn't really matter when you tokenize it. The tokenization itself has nothing to do with its legal structure. It's how it's traded. It's how it's traded.
And primary versus secondary distribution is a toggle. And I will say, just like Dave, in Venium, we have about roughly 85 billion of assets on our platform. 100% were already fully distributed on a primary basis, right? And what we're doing is we're facilitating mechanisms for more efficient secondary trading of closed-end funds, interval funds, private credit. This is what we're doing, creating secondary markets for fully distributed primary funds. And that will lead to eventually primary distribution of new funds. But Dave's right. We're seeing the same thing. Everything we do has already been fully distributed.
Dave, can I just ask, we must stop in a minute, but Dave, can I just ask a possibly stupid question here? I'm running a 40 Act fund. It's being sold and distributed in the traditional way. I notice over there's a pocket of investors who'd like to buy it in a tokenized form. What do I do? Just create a tokenized share class? And who answers the question that you are meant to answer, which is who owns which? How do you end up with a single register of who owns the tokenized version of the fund and who owns the traditional?
Most funds use a fund admin or some fund manager already. So the structure is already there. I mean, hey, look, if you're on this call and you're a fund admin and you want to license my platform and tokenize assets, call me up. But in our system, we have non-tokenized and tokenized assets in the same round, in the same fund, side by side. So our system can handle both in the same offering, in the same asset, and one can be tokenized, one can be not tokenized. It's really at the discretion of the issuer. There's the tokenization of the asset is just like, do you store it in a Word document or a PDF? It's the same thing. It's no different than that. Okay. The interesting thing about tokenization is it creates an immutable ledger, which is auditable and more transparent than something that's on a spreadsheet, that's something that's in a central database. And it is a representation of ownership. The ownership is really held at the legal level, one level of abstraction above the token. Okay, that's where the real legal stuff happens. The real legal stuff does not happen in the token. End of story. In tokens, to Pat's point, tokens are not replacing lawyers. They're not going to replace a whole bunch of logic and this stuff anytime soon. They're really a certificate of authenticity with an audit trail associated with them.
And they may have compute functions built in, right? But those compute functions every compute function itself is going to have to be auditable, not just the share, meaning where did I pull that data from? I need to recreate that calculation from which I did a distribution or from which I set a public mark. Yep. And how do we audit that? And so all of that compute function, when you see these tokenized funds, and I want to just real quick go from something you said at the beginning, Dominic.
Do be quick, Pat. We're over time. Yeah.
Oh, sorry. The way the market started was J.P. Morgan and Goldman, in I would say in earnest with institutional players laying in, was in the repo market. You know what I mean? And they're trading massive repo back and forth to each other in a tokenized form. But there's no spread in that. So they want to get in and start to be market makers in alts. And as they do that, they're going to capture spread as liquidity comes. So they're going into that. I would say 90% of the compute function is happening off chain. 10% of the compute function is happening in smart contracts today.
Okay, we must stop in a minute, but I'd like to give each of you a chance just to give the audience something to take away from this. And my question is this, and perhaps I'll put it to you first. Kevin, listening to everything this afternoon, we haven't talked about blockchain, we haven't talked about tokenization, we haven't talked about fractionalization or smart contracts, any of that stuff. We have, I think, agreed that there's a big opportunity here, and regulation and data are coming together to enable that opportunity to be realized. But an awful lot of people listening to this call, CSDs, asset managers, custodian bankers, fund administrators, fund managers, etc., are actually probably feeling a lot more positive than they would have done if we talked about this a year ago, because they're all going to survive. They're going to do something slightly different. It's going to be a big new opportunity for them. I'm kind of answering the question for you a bit here, but what is your perception of how this is going to unfold over the next 3 to 5 years? Are we going to end up with a structure very like the traditional marketplace, but just making markets in tokens, investing in tokens, trading tokens, broking tokens, custodying tokens, safekeeping tokens? Is that the world we're heading towards here?
Well, I think it's a complex question. I don't have the answer in where the world is going to be in 3 to 5 years. I think we all agree, started saying that actually this is all very experimental. There are ways where it works, there are ways where it's broken, and we tend to agree that technology can play a big role in improving significantly the way private market works. So I think the main takeaway of this great conversation for me is that we know tokenization can be used in many ways. Right? There's just many ways business models can be reinvented and rebuilt to create customer value, investor value using blockchain and tokenization. So that's one thing. And one thing that I think Dave said really well is that there's nothing new under the sun. Right? This is all exists. This is going to be the same, but just using new technology to improve the efficiency and the transparency and the data. Nothing new is new. And my kind of advice for whatever it's worth is that people who are ignoring this thing right now are typically the people who are ignoring AI 10, 20 years ago, right? So if you ignore blockchain right now, you're going to be behind your customers, your competitors who are using that technology. For me, if there's anything I have got certainty on is, ignoring blockchain right now is a big mistake. Ignoring the way you can make assets more liquid and transferable and more transparent is a big mistake.
Pat, a last word from you. You've heard Kevin say, in effect, that this is bringing familiar technologies or familiar roles to play in the private asset market, just making them more efficient. This isn't about a transformation. This isn't about a replacement. It's not an upgrade. It's just bringing stuff we know already efficiently to privately managed assets. You've made your point about data. Do you agree with that with what Kevin is saying, Pat?
I fundamentally agree with everything. It's just we have to put an order of magnitude on it. Because in many ways, we're literally going from physical book entry, not just to the printing press, but to the internet, right? And I mean, it is speeding up processes dramatically. Real-time surveillance of real-time assets is going to drive valuation data. You're going to be able to have instantaneous understanding of the asset. It's going to be ready for sale 24/7. And when you have third-party marks on that, and that's rolled up into an interval fund, people like Blackstone aren't going to need to go to CalPERS for a $4 million infusion of cash because they've run out of space in their interval fund, because it will be listed on an exchange like ADDX. And that will do away with the interval fund's need for a $4 billion bailout, because there'll be a secondary trading market for it. And so literally, this is going to speed the innovation in the private markets, where you're going to see things like index funds, you're going to see derivatives, you're going to be able to implement an economic thesis with more purity and more precision in the private market than you ever have before. And that's what we're going to start seeing.
Dave, you've heard Pat say we're moving from an analog world to a Web3 world without an intervening period in the Web 1 or Web 2 worlds, which is quite a wrenching transition, but it's going to actually be surprisingly familiar when we get there. Is that a reasonable takeaway for people, for me to, and the people listening to the webinar to go home with?
Well, I think what Pat is doing is simple: is ask the impossible and get the unreasonable. So that's, I think that's a good way to do things. You'll get what you want that way. Look, this is really simple. Whether because of the demand from investors or whether by the diktat of regulators, private assets are the next large market. They're being digitized. Using this technology to digitize assets so they can be bought and sold more efficiently makes a lot of sense. This is not extraterrestrial technology. This is a step function improvement. Do not think like this is something that you can't deal with or master. And you can call any of us on here. And if you want to put up with listening to this stuff again, we'll tell you why this makes a lot of sense. And it is not ornamental, and it is not cryptocurrency, and it is not FTX, and it will fix the Archegos problem. We are going to fix the Archegos, the Three Arrows Capital, the Celsius, the FTX problems, which are all related to lack of transparency and lack of auditability and cross-collateralization. This is what we're solving here. This is not hobbyist stuff. It is like engine room stuff here.
Oyi, it falls to you, I'm afraid, to have a last word about this. You've just heard Dave say this doesn't need to be a massively wrenching transition for existing institutions to take part in this. It's actually going to be relatively familiar to them and much easier than they perhaps thought.
Well, I think, I agree with that, right? Actually, the technology, as Dave said, it's not extraterrestrial, right? It's something that, I mean, it's been used and it's been scaled and obviously in a different setting. But, you know, as you way started out, my prediction with BCG is 16 trillion, right? The addressable market. And that is going to be a combination of, I mean, we all here have a role to play, obviously, because we have a certain sort of vision and we're moving quite quickly with tech. But the world is not going to move towards that 16 trillion with just the 5 of us or 4 of us here, right? We will see the rest of the world slowly adopting that. And I think, you know, Pat mentioned this earlier, and I'm with him, the amount of conversations that we're having with TradFi and the amount of work that's being done in TradFi, it's actually not that obvious, but it is happening. And so I think, and again, it is not so obvious because it's an engine room conversation. We obviously talk about it, you know, in a very passionate way, because that's where we see we want to change the world. But you're already starting to see those conversations happening within TradFi, and that's being built towards, or we are converging with that TradFi. So this particular move, I think in 5 years' time, if we're still having these webinars to talk about tokenization, I think we would have failed. But I actually don't see us having these webinars in 3 to 5 years' time, because it would be so built into the infrastructure and the financial services world.
It's like talking about having a website, you know, in 5 years, right? You know, who
Okay, when we stop talking about this, we will have succeeded. I'm afraid we must stop there, because we've run at least 10 minutes over our allotted time span. But I'm leaving this with the feeling that the reason privately managed assets are leading the tokenization debate is because they're leading convergence with TradFi. And I rather like that idea of extraterrestrial technology, Dave. I'm going to pocket that one. It's not a case of ET go home, it's an ET feel at home already. But we better stop there. I'd like to thank our panelists, Pat O'Meara from Invenium, Kevin Montserrat from Consilience Group, Oyi Chu from ADEX. Thanks for staying up with us, Oyi. Appreciate that a lot. And of course, Dave Hendricks from Vitalo. Thank you also to you, our audience, for your questions and your comments. Here at Future of Finance, our next webinar is exactly 1 week today away, Thursday, the 26th of January, same time, 1400 London time, same place, Zoom. We'll be looking at stablecoins and in particular their regulation, their coming regulation, what the implications of that are for the markets. I hope that many of you will join us then, but for now it's goodbye from the 5 of us. Goodbye.